Hey, friend, welcome back to the Live Off Rents show, where we bring in real estate and other financial experts to help you build passive income, create your dream lifestyle, reach financial independence, all of the above. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm on this journey with you. Not only do we feature different passive investment every month in our club, our co-investing club, I'm in the trenches right there with you. So without further ado, let's jump in and talk to today's guest, Kevin Amolsch. He's been a real estate investor for over 20 years, been a lender for over 16 years. He founded the Pine Financial Group in 2008. He and his companies have closed on over 2,500 transactions as a buyer, a seller, and private money lender. So, Kevin, welcome to the show.
Brian, I'm so happy to be here. I know we're going to be short and sweet, but I have some fun stories, so let's get going.
Oh, yeah, I'm super excited to hear about your journey. You got into real estate around the same time I did, so that always makes for some fun war stories. Let's rewind the clock to the very beginning. How did you get into real estate in the first place?
Gosh, I don't talk to very many people, Brian, that have been doing this for over 2 decades. So you went right through the crash as I did. So that might be some fun stories if we get there. But yeah, let's go all the way back. I was in the military at the time, and I was trying to figure out where can I invest some cash, because I had a little bit, but I didn't really have a ton of time. And I just started reading books, right? And then I picked up that purple Bible,
Yeah, there you go.
same book that I'm reading to my 13-year-old daughter. We read together every single night. So we're going through that. And dude, just last night, she's like, okay, so you're saying that an asset might lose value from my balance sheet to when I actually liquidate it. So does that mean, and it was just so cool to go through that conversation with her. But you know, in Kiyosaki's book, he talks a lot about investing in real estate. So I started focusing in on that, and you know what, he was right. It is, in my opinion, the best investment you can make. So I started buying a house or two a month, and here I am, a broke college kid. I literally, like, my kitchen was full of top ramen and a keg of beer in the fridge, and that was it. And I was figuring out how to buy a house or two a month. And what I learned from that process is that I really love the financing side of the business. If you could figure out how to nail that, you could become extremely rich, because the financing is the deal. It's how you make your offer. It's how you negotiate it. It's how you structure, put it together. It all comes down to the money. So that's sort of how I found myself in the private lending business. And I still do my investing on the side as well. But I just really love the financing side. So I'm helping other investors with that.
Well, there's so much there that I love. Not least of which surviving on ramen and beer as a broke college student. So actually, well, on that note, I just have to ask, how were you able to afford buying a house or two every month as a broke college student?
Yeah. And so it all comes down to credibility, not cash and credit. So if you can get into a living room with someone that's motivated to sell, and you can figure out how to solve their problem, you could kind of create anything you want. So I was buying properties with no money down, no loans. I was just getting the seller to help, participate in the financing, whether that's a lease with an option to buy, or taking over their payments, or whatever other creative strategies we can come up with together. But it really is belly to belly. Like, you have to sit down and negotiate this with the seller to have that kind of success. Otherwise, if you're in the MLS and working with brokers, there's nothing necessarily wrong with that. In fact, I do that now, but you're not going to get those no money down opportunities when you have that situation.
Yeah, well, that's certainly true. And it's really hard to find outstanding deals on the MLS, right? Because by definition, you're paying market pricing if you're up against every other buyer in the market, right? So I mean, I'm sure that
you
there
and
are
I agree on
exceptions,
that. No one, not everyone agrees on that, Brian. Some
well,
people
all
say,
right,
"Well,
well,
I'll find a fantastic
push
deal."
back. I want to hear the counter argument here.
Yeah, I'll give you the counter argument, but I want to be very clear that I agree with you. It is such a large database of buyers. I mean, it's the entire market. Everybody, you and I, we all could see it. So it does trade at the value, in my opinion. But other people will tell you, no, I find great deals in the MLS all the time. I'm like, okay, well, what's the definition of great deal? I mean, I believe you, but I just need to understand what that definition is. Because what we're seeing with our clients, if you're in the fix and flip business and you're finding stuff in the MLS, that you're still paying market value, in my opinion. But you found a way to creatively, or not creatively, but you found a way to add value to that. And that's where your profit is. The profit isn't in the discount that you negotiate. The profit's in the added value. That's how I feel, but I do get pushback on that. So
yeah, I mean,
what do you think?
So I mean, to me, it seems, I mean, almost by definition, if a property is listed on the market and you're competing with everyone else in the market, then what that property sells for is inherently the market value, as opposed to, sitting down with someone who's in foreclosure, and saying, hey, you owe a third of what your property is worth. I'll buy it from you for what you owe on it. You can lease it back from me and then, buy it back, within a couple years or whatever at a certain, but that if you're buying a property for a third of its market value, that's a score, right? I mean, that's a great deal. If you're paying whatever is listed on the MLS or whatever someone is willing to pay on the MLS, that's market value. But anyway, I don't want to go down too much of a rabbit hole here. So yeah, no, that's great. I love that you were buying these on terms, doing creative financing, because so many novice real estate investors don't know that side of the business, right? And that is often where you talked about creating equity and creating good deals out of something that maybe isn't a spectacular buy-in price. Sometimes the creative financing is the differentiator with those.
Oh, for sure. Like you could pay full price for a house all day long if you get great financing on it.
Yeah, exactly. And in fact, Kiyosaki talks about that all the time. How he would rather have a mediocre buy-in price with spectacular financing terms than vice versa. So
yeah, you have all of the flexibility if you have good debt in place. So just renting it sounds like cash flow from rentals. Well, if you have a cash flowing property, even if you owe more than it's worth. Now hear this, you could owe more than it's worth and be extremely profitable, and you can hold on to it forever. Where you get in trouble is if that cash flow goes negative. Right? You have a turnover or something that you can't afford, you don't have the reserves. That's when you get yourself in trouble. But if it's a profitable property, it doesn't matter if you owe more or less. You just hold on to it.
Right. It's like holding a dividend paying stock, right? The stock market's going to go up and down and all over the place, but as long as you can hold it for the long term, that the stock market is going to recover eventually.
Eventually, exactly.
Maybe not this year. Right. But 1 year from now, 3 years from now, it will recover. So if you can wait that out, then to your point, you're fine. You can just sit back and collect the passive income every month and wait out the bad market.
Yeah, and I learned this in 2008 when I lost my ass with every other real estate investor in this country. Right, we all took a bath in that time. But if we were cash flowing, we could have withheld, right, and got ourselves on the other side, and that's where the real money's made.
Yeah. So that was one of the areas where I really messed up in, getting started in real estate investing in the mid-aughts, which is like the worst time in the world to start investing in real estate in retrospect. But yeah, I didn't know how to forecast cash flow. So I'm an idiot kid thinking that the cash flow is the rent minus the mortgage. And and in the for the first couple of years, the market was so forgiving that you could make those mistakes and then say, oh, well, I'm just going to sell this property. And I have this great, appreciation on it. And then in 2008, all you can see who's swimming naked, right? When the tide goes out, as Warren Buffett says, you can see who's been swimming naked. And I was definitely swimming naked.
Me too.
So anyway, back to your journey as a real estate investor. So how did you first get into hard money lending? How did you make that transition from being a real estate investor? You're buying income properties largely on terms with creative financing, and then you made a transition, or at least you added that new component to your investing business. Walk us through that.
Yeah, so because I've had success in that arena and I was buying a lot of properties and I was wholesaling and fix and flipping and then I was keeping a bunch. I went into the recession with almost 60 single family homes. Oh, so wow. It was a pretty large portfolio. And I actually got recruited by a mortgage broker to just originate loans. And it was a fantastic opportunity for me to just add another revenue stream to my current business. And people give fee-based services a hard time. Like you're not investing, you're not planning for your future if you're working on a fee, like a commission. I think that's ridiculous. I think cash flow and multiple streams of it is vital to your success. Now, can you take money from a commission-based or a fee-based business and invest it into real estate? Well, yes, that's probably what you should do, or other income-producing asset. It doesn't have to be real estate. So I was like, well, if I can generate chunks of cash by just talking to people that I'm already talking to, then I should probably look at that. So I became a mortgage broker. And then, in 2006, I remember it pretty clearly. Everything started to change. Interest rates were going up. These negative amortization loans became difficult. You had a lot of IO, interest only. And,
I
and I was like, I need to diversify this section of my business because it's doing well and my rentals aren't. So I just wanted more control of my business. And I met Susan. Her name was Susan. She took me under her wing and she introduced me to one guy. He had $100,000 in cash. And she says, well, let me just kind of show you what I do on the private lending side. And you do it with this one guy. And so I took his money and I loaned it out to a fix and flipper. It was a $100,000 investment. And I took a small little fee to do that. And there I was entering into the private lending business. I didn't know what in the heck I was doing. In fact, I was breaking the law. I didn't even know it at the time because you're not allowed to. At that time, the SAFE Act had already come into play, and now you had to be licensed. And I wasn't licensed, and this securities licensing and all of this. But it got me going. It got me going. And then I talked to the regulators. I figured out the business. And 2008, Susan wanted to do her own thing. I wanted to do my own thing. And that's sort of how Pine Financial was born.
Okay. So you met with this, let's call him a deep pockets investor who has
$100,000.
Yeah, I mean, it's not like he's a
like
whale in poker terms or whatever, right?
Yeah, exactly.
He's not a billionaire, but he's got capital that he wants to invest. You're working with him to find borrowers and lend out some of that money, and maybe starting to use some of your own. So how do you scale from there as a entry level hard money lender, or someone who's just becoming a hard money lender?
Yeah. So I'll tell you this, when you do what you say you're going to do, it's not hard to raise money. So it actually starts coming fairly easily. But to meet more people at the beginning, I just started doing seminars, and here I am peeling back the curtain for you, Brian, but it's just, hey, let me get in front of 4, 5, 6 people, whatever it is, whatever we can get into a room. I was teaming up with other real estate agents to try to leverage their email lists. And so I might have 5 or 6 people in a room, and I would just teach them how to fund real estate deals. So we'd go through conventional loans, private money. And so actually I was trying to raise money and lend money to the same room. And what I found was when you could show them how profitable private lending is and how safe it is, they want to work with you. And you're the expert, you're in front of the room. So that's another investor. I might pluck one out of a room of 5 or 6, and then I go to another and I don't get any. And then I do another one and I might pluck another one. And it's just slowly just building that up. And then, gosh, we started doing some webinars. I mean, what was it? Go-to webinar, I think it was at the time. Yeah. And the webinars were super successful. And then again, that's how I got going. But then, and then it's just referrals. Most of our business comes now from referrals, although I have a marketing department. The securities we sell are public, so we're allowed to market to them. It's not like the Reg Ds that so many other investors are doing.
Right.
So we have a bit of an advantage there. And we have a legal team. Like my COO is our general counsel. So we're able to stay compliant. So it's just scaled so much since John was the $100,000 guy. Thank you, John, for getting me going in this business.
There you go. So explain to people who aren't familiar with this. So as the business model of a hard money lender is, you raise money from other people, you've lend it out to real estate investors who want to fix and flip homes, or use the BRRRR model, fixing up a property and refinancing it as a rental. So do you earn a spread on what you're borrowing the money at and what you're lending it at, or is that even and you're just earning your money on points and fees to your borrowers?
Super profitable business, by the way. But hey, the feedback I was getting was, hey, the values of everything are going up, and we can no longer afford to do a one-to-one transactions. I can't fund the entire deal. It's not liquid. Look, private notes are not liquid. If you're going to liquidate, you're going to take a discount, so you'll lose money. And then diversification. Let's say you loan on a house and it defaults. Well, your income stops, right? But if I'm loaned over a whole bunch of houses, we can keep that income going. So how do I solve those 3 issues that the feedback I was getting? And that is a fund. So we created our first fund within 1 year of starting the business. Now we have 5 mortgage funds, And each one's structured a little bit differently, but we are able to collect management fees for managing those funds. We collect servicing fees on some of those. We sell notes to individual investors on occasion who wants to buy full loans, whole loans. We charge servicing fees on those as well. And then we have fees to our borrowers. So say I'm going to loan you money to do a fix and flip, right? I might say, okay, your origination fee or your points is 2, and then your interest rate is 12, let's say. So I make 2 points from you on that, and then a spread between the 12% and what I'm paying my investors. So there's multiple streams, right? And then that helps us take care of all of the overhead and pay our investors really well.
And out of curiosity, what are you paying your investors right now, interest rate wise?
Yeah, so it's an 8% pref, and then there's a little upside. So there's an 8% pref, 2% management fee, and then there's a split. And on this new fund that we just got approved, it's a 70-30. So 70 goes to the investor, 30% comes back to us. So that's how we structured that one. Investors really like the potential upside, right? One of our other funds is a flat 8, and it's like people are going to love this because it's a promised return. Like this is something that's not going to fluctuate at all. A pref return is preferential to management fees, but it doesn't mean promise or guarantee or any of that. It could go below, and our other fund is if we go below, we're still paying the 8.
Right.
People just say, oh, you have 15 years of track record of never missing that. So why would I assume you're going to miss that? I'd rather have the 8 plus the upside.
Yeah. So we, as you know, we run a passive real estate investing club, and we have invested in some debt periodically. Mostly we invest in like private equity real estate syndications because we do like that upside. But I like your model of offering upside as part of a debt fund. Most debt funds, at least that I've come across, it's a flat, it's a flat pref basically, or a flat interest rate that they just pay. So anyway, yeah, we'll have to talk offline about whether you guys might be a good fit for our investment club to look at.
Yeah, I'd love to. Yeah, and there's a big difference between debt and equity, right? So I invest my personal cash into equity funds also because there is more potential. The problem is, as you know, sometimes there's capital calls, sometimes there's delays, there's not monthly distributions, there's definitely not liquidity. Like you're definitely on the ride, right? You can't get off. So there are some advantages to a debt fund over equity if you're a little bit more conservative, but you're absolutely right. You should definitely expect a lower return investing in debt.
Yeah. So speaking of term, what is the term for your debt fund? What's because people can rotate in and out is what I take it, right?
Yeah. This is the very first one that we put a lock-in period. None of our other funds have a lock-in, but what I learned from the public fund is somebody might come in with 10 or 15 grand, and those investors are a little bit tougher to manage. And then all of a sudden something comes up and they want their money back. So they're using almost like a savings account, which is not the intent here. Right. We don't have unlimited access to cash. So whenever we get a redemption request, we got to go out and get a loan to pay off, wait for a loan to pay off, free up the cash. And then, so it's kind of an administrative headache. So we decided, we're sick of that for now. Let's get people in here who are actually serious about a longer term relationship. So we did a 9-month lockup, and then it's totally liquid after that.
Okay. And do you allow non-accredited investors in your fund?
Yes, that's such a good question. The public fund is accepting non-accredited investors, so an unlimited amount of non-accredited. The one with the upside that we just talked about, that little extra kick, that's a 506C, which I'm sure you know all about. So that one is going to be accredited only.
Gotcha. Okay. Understood.
Yeah.
No, I love it. And one last question about your fund here. Just you got me nerding out as someone who spends a lot of time every week looking at passive real estate investments.
I'm sure you do. Yeah.
So what's the minimum investment with your various fund options?
So the two right now, we have Fund 5 and Fund 6. Fund 5 is the public one, and that's because we're trying to help as many people as possible. We have a really low entry point. It's $10,000. The 506C, which is the accredited only, much higher, easier to manage. We don't have any broker dealers or anything involved. We do everything in-house. That's $100,000 minimum.
Gotcha. Okay. So Kevin, I want to be mindful of your time here, but I do want to ask you one or two last questions for people who are on the borrowing side here, because a lot of our audience are active real estate investors, maybe they flip homes, maybe they are BRRRR investors. So what advice would you have for them as someone who's been both an investor and a lender what advice would you give someone to help them get approved every single time for hard money loans when they need financing?
Yeah, I think you need to build the relationship. This is absolutely 100% a relationship business. And I don't care what anybody says, that's going to be true. Even though hard money is becoming more of an industry, it wasn't like that just 5 years ago. It's definitely an industry now. There's definitely regulators looking at it, and there's institutional money coming into it. But it still comes down to the relationship. So I would start working and building on that now. And as much as I would love to work with everybody, it's a local business, you guys. We could bring in money from all over the country, but we don't lend it out all over. We're very geographically specific because that's how you keep your money safe. So you're going to want to probably look at your local hard money lenders and focus in on them. And then you should be pre-approved. Most hard money lenders will allow that. Get pre-approved. It's probably not going to cost you anything. They probably won't even pull your credit until you have a deal under contract. And then that way you can get your commitment letters, your loan commitment letters. You could show the sellers that you have a little bit of money behind you, and it just further strengthens your offer so you have a better chance of success.
Awesome. So Kevin, if people are interested in either investing money with you or borrowing from you as an active real estate investor, how can people connect with you?
Yeah, there's two ways here. I wanted to mention, we talked a tiny bit about the economy back in 2006, 7, 8, and then going into 10, 11, where all the opportunities were. And I get questions all the time. Are we in a situation like that? Because there's still headlines out there. We're going to fall into a recession. I don't think so. But I do see some resemblance to the 1990 crash coming out of the savings and loan, hyperinflation, high interest rates to what we're going through today. So I wrote a report comparing now to that recession because that's the most similar. I'm going to give that to your listeners for free at thepinereport.com. So go download that report, thepinereport.com. Nothing is better at predicting what might happen than history. Even though it's not going to happen exactly like it does rhyme, they say, right? So I think that's a good way to at least get a better understanding of what we're going through right now. And then otherwise, you could reach me at pinefinancialgroup.com.
Awesome. And I love that way of looking at it, that history rhymes, because it's never exactly the same, but it does repeat itself, right?
You can learn from it for sure.
Yeah. So Kevin, thank you so much for coming on today. This was a lot of fun.
Yeah, Brian, I really appreciate you having me on.
Absolutely. Well, guys, if you enjoy these conversations that we have, please rate, review the show. It means the world to us. And stay in touch. Support at sparkrental.com. You can reach me personally at brian@sparkrental.com, and we will catch you next week. Have a good one, guys.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have average returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rental's Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.